Hello, my name is Paul Jones and I've worked in the city for over a decade, and what I'm going to talk to you today about is the difference between in the money, otherwise known as ITM, out the money, otherwise known as OTM, or at the money, otherwise known as ATM. And if you like these information videos, then what I suggest you do is, after you've watched this video, that you go to the website crashmarketstock.com, just here, and you can get this in writing and a whole host of other information around options trading. And you'll see a testimonial for someone who has put in just 4 trades and earned just under $10,000. So a lot of money to be made. So let's get into it then. The in the money, out of the money, or at the money. So let's look at in the money. An in the money call option is described as a call whose strike or exercise price is lower than the present price of the underlying. An in the money put is a put whose strike or exercise price is higher than the present price of the underlying. So as the name would suggest, an option which could be exercised immediately for a cash credit is an in the money option. So in our Microsoft example, which you just saw, an in the money call option would be any listed call option with a strike price below $65, as you can see here, which is the price of the stock. So the MSFT January 60 call option would be an example of an in the money call. The reason is that at any time prior to the expiration date you could exercise the option and profit from the difference in value. In this case, $5, $65, which is the stock price, minus $60, the call option strike price, which equals $5 of intrinsic value. In other words, the option is $5 in the money. Using our Microsoft example, as in the money put option would be any listed put option with a strike price above $65, the price of the stock. The MSFT January 70 put option would be an example of an in the money put. It is in the money because at any time prior to the expiration date you could exercise this option and profit from the difference in value. In this case, $5, $70 put option strike price, $65 stock price, $5 of profit. So moving on to out of the money. So as you would expect, an out of the money call is described as a call whose exercise price or strike price is higher than the present price of the underlying. Thus, an out of the money call option's entire premium consists of only extrinsic value. There is no intrinsic value in an out of the money call, because the option strike price is higher than the current stock price. For example, if you chose to exercise the MSFT January 70 call while the stock was trading at $65, you would essentially be choosing to buy the stock for $70 when the stock is trading at $65 in the open market. This action would result in a $5 loss, so obviously you wouldn't do it. An out of the money put has an exercise price that is lower than the present price of the underlying. Thus, an out of the money put option's entire premium consists of only extrinsic value. There is no intrinsic value in an out of the money put option because the option strike price is lower than the current stock price. For example, if you chose to exercise the MSFT January 60 put while the stock was trading at $65, you would be choosing to sell the stock at $60 when the stock is trading at $65 in the open market. This action would result in a $5 loss. Obviously, again, you wouldn't do it. So this video presentation was just a short description on the difference between in the money, out of the money, or at the money. If you do want to know more information about this, then I suggest that you go to www.crash-market-stock.com All you need is to put your first name and your email address, and you'll get tons of really useful information and offers and secrets. So my name has been Paul Jones. I appreciate you listening, and I'll hopefully catch up with you in the next video.